Thank you. Let's get into our presentation today. We are talking about options and we are talking about earnings and a strategy that works pretty well with stocks that just don't really move around earnings. So let me just throw up the disclaimer that we typically throw up at each presentation. It reads pretty much the same thing as all of the disclaimers that you see. And we will jump right into it. So our topics for today is, as I mentioned, I'm going to go over the overview of a strategy that we utilize to trade options around earnings. We're going to identify quiet stocks, meaning stocks that just don't move very much, even through their earnings announcements. We'll talk about volatility and how that impacts our trading, and I'll create a iron condor specific option strategy called an iron condor that we're going to use for these trades. All right, now let's get started. My name is Jeffrey Beamer. I am the senior investment strategist over at ewotrader.com. I have been in the industry for almost 40 years, I hate to say. I've been the founder or general partner of several investment firms and hedge funds over the years. I've been very active in the securities industry all my life. And different industries such as the Security Traders Association, the Market Technicians Association, and the National Association of Active Investment Managers. So I've been around the block a couple of times and still love doing what I do each and every day. So let's go over what we're going to talk about. As I mentioned, I gave you the little highlights, but we are going to talk about earnings. Now, we're in the quiet period of earnings right now. We are at the very end of the current cycle. Next week, specifically 1 week from this coming Friday, we begin the next cycle with JP Morgan, Wells Fargo, Blackstone, and many others they're clearing on a Friday, which is a little odd, but that kicks off the next earnings cycle. The following week is going to be a little quiet because it's only a 4-day trading week, and after the week of Easter, we really kick things off with earnings, and we have hundreds and hundreds of earnings announcements each and every day, 1,000 a week pretty quickly. So as an example, this week we only have, I think it is 134 stocks declaring this week, I believe is the number. So, very quiet now, but it won't be for long. All right. Now, many traders struggle with earnings, especially trading options around earnings, because they either have picked the wrong strategy or they just use the wrong options. And there's a little technique that I'm going to show you today that might help with becoming a little bit more successful through your trading if you do like to trade earnings. I like trading earnings because they're always very exciting, and many stocks break out big and other stocks just consolidate. And we're going to talk about the consolidators. All right. So I've been consistently successful with this strategy over time, and we offer this as a subscription service to our subscribers, and we trade this each and every week through all the weeks of earnings. All right. So I'm going to show you how to profit with this and how to pick you don't have to pick a direction because the stock probably isn't going to move. All right. If we pick it correctly. All right, so how do we identify these quiet stocks around earnings? All right, here is an example. All right, this is Pfizer. This is one of our quiet stocks. Pfizer has an average move of less than 4% over the past 5 earnings cycles. Okay, the stock has been stuck in a $6.50 trading range. As you can see, this snapshot was taken at the very beginning of March of this year, and I just put an ellipse on the first earnings announcement in this 5 cycles of earnings. Okay, the first cycle, and you can see the stock chart. The stock just didn't really even move. All right, now we did get a gap the second series. Okay, the second announcement, stock did gap up, but it only gapped up a couple of dollars. And nothing big, no 2-digit big move, jumping from $20 to $35 or nothing like that, like we see with some stocks. The next earnings announcement came at the top of the channel, and again, not really anything notable. And we just keep rinse, repeat. Every time we head into an earnings announcement with Pfizer, we will usually put on one of these trades. Now, there's more that goes into it. I'll talk about that. We'll talk about, what to look for, but option market makers help us out a lot by doing something around each and every earnings cycle. And I'm going to show you, you're going to visually see what they do and what really gives us an edge in these trades. So stick around. We're going to go over that pretty quickly. All right. So how do you identify these quiet trade candidates? All right. Well, this is one of the things where volatility comes into play. There's two types of volatility. Okay. There's statistical volatility, which is historical. It's what you see on the chart, like we just looked at with Pfizer. We were looking at the chart. That's called historical. And then another one is called implied. Implied volatility is not as easy to see. You usually need some specialty option pricing software to help see it. But I'm gonna show you that here in just a moment. I'll show you a picture of it. But we begin this process by creating a list. Okay, we start by building a list of stocks with upcoming earnings announcements. So how do you find that? Well, it's available pretty readily these days. Okay, you can find it on most brokers' platforms. Okay, they will have a list or they'll show it on a chart when the next earnings announcement comes up. But then there's also other resources like Google Finance, Yahoo Finance, Reddit, etc. Many places you can go to find a list of upcoming earnings of companies that we're going to have earnings in the next week, in the next 2 weeks, in the next 3 weeks. And it's a pretty consistent process, a pretty consistent cycle. All right. And with the exception of a few every now and then, we know the dates of future earnings announcements for these publicly traded companies. So it's pretty easy to put together a list, and we just need to go through it and aggregate it and say, okay, I'm going to save this list and I'm going to go through it and see around these earnings event, how does this stock trade? Okay. So we create a list and then we analyze that list. All right. We use a chart to analyze price reaction around earnings. What does this stock usually do? And also is this stock, what sector is this stock in? That's a minor thing. Is this, for example, if it's not tech, if it's agriculture, if it's, what have you, if it's a telecom company, whatever. Right? We want to know, if it's kind of in the news or if it's out of the news. I love out of the news stocks with this strategy, things that just really aren't talked about a lot. Okay. And we analyze that price. All right. Those price charts, just like I did with Pfizer. So here's an older chart of NVIDIA before the split. Okay. We look at, you can visually see here that, okay, we had a gap back that first earnings announcement that you could see on the screen. Okay. But then afterwards, we have these, boy, the stock really didn't move through that second earnings announcement. No, around the third earnings announcement, stock really didn't move. In fact, now post-split, I can tell you that NVIDIA, for all that, it's in the news consistently, through their earnings event is a single-digit mover. Okay, what's a single-digit mover? A single-digit mover is one that moves less than 10%. Okay, meaning it will move on average around 7-8% through earnings. Now, to some of you, you may say, oh, well, that's kind of a big move for a stock, 7%. I'll take that. If you're bullish and the stock goes up, that's great. Well, if the stock is, if the stock goes down, is that so great for you? It could be if you're an option trader, but what we're looking for is some help from the option market makers, and they're going to help us help tell us which of these stocks we want to be trading this strategy on. Okay, so and I'm going to give you some specific examples here in just a moment. So really, NVIDIA, maybe once out of every 5 or out of 6 earnings announcements may move double digits, but right now that stock is pretty quiet. You can pull up the list on your own, the stock on your own, and just look. And we're focused just on the earnings date. Okay, just on the day of earnings. Is this thing moving double digits? Is it moving single digits? And yes, there are some stocks that move incredible amounts over earnings, 20%, 30%. And we usually don't, we use a different strategy for that. That's a different publication that we do. But I like these quiet stocks just because I don't have to worry about them and I don't really have to babysit them very much. Okay, so You can use indicators such like technical indicators such as Bollinger Bands or average true range. They may help assess the price reactions. I have an example here where anytime you go through the earnings announcement and you see the Bollinger Bands stay constricted, that's going to be evident of a lack of movement. You can see they will expand after a big move, okay? But then through a quiet move, unless the stock moves big, as you see on the last earnings announcement here, stock moved big prior to the announcement, that widened those bands, but we start getting into the earnings announcement and they're collapsing pretty quickly. Or average true range. Average true range will spike up if there's a big move. Otherwise, it will just be pretty quiet and just continue with its either uptrend or downtrend as the stock moves around. So, technical indicators kind of help us, but oftentimes, again, it's all historical. It's what has that stock done in the past, all right? And will it continue in the future? So, while past performance does not guarantee future results, for the most part, with a lot of these stocks, they're very mature companies. They've been around a long time. They're on a different cycle now. They're through their growth cycle and they're in their maturity phase, and they're just not moving very much like maybe they used to. And there are stocks that used to move big that don't move so big anymore, and now stocks that used to move pretty quiet that move big. So how do we figure those out? Again, the options market is going to help us determine that. All right. So you can use professional tools such as scanners and everything. Your broker may have an earnings scanner to help figure out when a stock is going to declare earnings, or what is the anticipated move of the earnings. For example, some brokers in the option chain will use terms like probability of touch, okay, or probability of expiration, meaning expiring worthless. All right, and those numbers will expand and contract up and near the earnings announcement and come back down after the earnings announcement. Okay, so there's things like that. You don't have to use professional tools, but they definitely do help. All right, so either your broker or some third party, it's always good to use tools if they're available to you. Otherwise, like I said, you can go to a free chart platform and look this stuff up, and you can see for yourself, does this stock move through earnings? And again, I'm not worried about prior to earnings, okay, what the stock moves, in January or February. If earnings are on, March 31st, I'm not really worried about the stock movement. I'm worried about what was that movement on those prior 4, 5, 6, 7, 8, 9 earnings cycles previously. What has the stock always done? Okay, now let's talk about the different type of volatility. Right now, we've been talking about statistical volatility and what you can see. And then something a little harder to see, as I mentioned, is implied volatility. Okay, now here's an example of PayPal. And this is an IV chart of only 7 to 30 day options, meaning this chart is looking at all options that expire in the next 7 to 30 days for PayPal. Okay, and this is a kind of a look back at PayPal. Now you'll notice something very interesting, that as we head into the earnings announcements are identified with the green triangle, okay? And notice right before the earnings announcement, we get what's called an IV, okay? So implied volatility, an IV rush into the options. And then the announcement happens, and look what happens to implied volatility after the announcement. We get an IV crush, all right? Now, what's interesting is that when people start trading options and they say they like a stock and they buy call options and the stock starts to move up, what usually happens is implied volatility usually moves down when a stock moves higher, okay? Because people are making money, they're comfortable, so there's no fear in the market, so the implied volatility drops. Well, the same thing happens quarterly, okay, around earnings. What is the stock going to declare? Are they going to have a big hit? Are they going to have a big miss? What is the outlook going to be? All of these things creates a lot of buzz before the earnings announcement. Well, guess what? Then you get a period of low volatility, and then a few weeks before the next earnings announcement, we get another IV rush. The options get much more expensive. That's what IV rush means. That implied volatility is one of the pricing components of options, and all of a sudden the options go from maybe 50 cents to 60 cents to 65 cents to 70, 75, and they start getting really expensive for no other reason than there's a potential news event coming up. All right, there's a potential news event coming up. We're unsure of the future. Okay, guess what's happening today in about 45 minutes? There is a big announcement that is going to probably impact the market, either severely or not severely, one of the two. Okay, and same thing has happened. IV over really the market is elevated right now, okay, because there is uncertainty. What happened after the earnings announcement? IV goes down. And this happens like clockwork on every stock. IV rush before the earnings announcements, IV crush after the announcement. Yes, it bounces around when it's low, but then all of a sudden it pops back up. Oh, earnings announcements coming up. Oh, we had the earnings announcement, and down it goes. And it happens in a flash. Okay. Now the IV rush takes a little time. It'll take a few days or even a couple of weeks. And you can see on the downside, I mean, look at the downside of this third earnings announcement. Look at that just steep drop. I mean, it happens immediately after the earnings announcement. What were the results? And then boom, even if it was great, even if it was horrible, it doesn't matter. IV just drops like a rock because now the news is known. Okay, we know what the news is going to be. All right, so this is how the option market makers help us out. They're pumping up the pricing, and we are using a strategy that is done at a credit. All right, so when we put this trade on, it's done at a credit, and we want those options to be expensive because obviously we're getting a better price for them. And then after the announcement, we want those options to lose value because that's how we make money, is by them dropping in value. If I sell something at 75 cents and I can buy it back for 10 cents, that's great. I've made 60 cents on the trade. That's great. If I can sell something high and buy it back low, it's exactly what I want to do. All right, and that's what we're doing here with the strategy. So let me spend just a few minutes talking about the strategy. If you're an option trader, you know what an iron condor is, you know how it's set up. Really, it's pretty simple. It's two vertical spreads combined together. We are selling both of them. We're selling a call spread on top. We're selling a put spread on the bottom. Okay. And for those of you not so familiar with options, we are just buyers and sellers. That's all you can do with options. You can buy them and sell them to open, or you can buy them and sell them to close them. That's it. That's it. You can buy them and sell them to open, or buy them and sell them to close them. All right. And so we're going to do a series of that right now. All right. So a review of the strategy a little bit. As I mentioned, we're combining two vertical spreads together. We're selling a put spread on the bottom. Okay, so that's known as a bull put spread, and we're selling a call spread on the top. That's known as a bear call spread. We're doing this together. Okay, so both of these are done at a credit. So then we add those two credits together and we get one credit. Okay, so like if I can sell the put spread for $1 and then sell the call spread for $1, now I get $2. Okay, that's how that works. And there's a really good thing. See, option market makers are some of the option traders are some of the smartest people in the business. And the OCC, the Options Clearing Corporation, is one of those as well. And I'm going to tell you where they do us a huge favor in just a moment. Okay. Now, these two credit spreads create a larger credit than one. The goal is to generate income through the premiums received while minimizing risks through the purchased options. All right, now the purchased options are just a hedge. All right, so of a bear call spread, we're selling the lower call, we're buying the higher call. That higher call is what the industry calls is a trash option. its only job is to hedge off our risk in the trade and reduce the margin required in the trade. That's its only job. Okay, same thing on the put side. Okay, the lower strike put that we're buying is a trash option. Its only job is to hedge off the risk. Okay, so we're not selling anything naked. We're not selling calls naked. We're not selling puts naked. They're always covered. That's why these are vertical spreads that we're doing. Okay, this makes a profit if the underlying asset remains within a certain price range until expiration and incurs a loss if the asset moves outside of the range. Okay, now there's a break even established with this trade, and I'll show you what that is. Okay, because I'm a visual guy and I like to see what I'm doing and see the trade. So let's put these things together. Okay, so you begin we'll start with the put side. The long put that I called the trash option. Let's say we're buying the 40 strike put and we're going to sell the higher. Okay, in this case we're going to sell the 45 put. Now that's going to generate a credit. Okay, and in this case it's going to generate, let's say, a credit of $1, and then we're going to have $4 of risk, which is called $4 in margin. Okay, so that's that maximum risk. Now, why on earth would we do this? Why would somebody do this? Why would somebody risk more than they're going to make in a trade? And the answer to that is pretty simple. It's about odds. It's about odds and probabilities. Okay, odds and probabilities, and the probability of a stock moving down below $40, or in this case, the break even in our trade, which would be $44. We want the likelihood of that is not, is very low. Still a possibility, but very low. Okay. Now on the call side, it's the same thing but reversed. Okay. So we're gonna sell that call in this case at a different strike. So here's the 50, and we're gonna buy the 55. Okay. The 55 call is our trash option. We want the credit from that 50 is what we're concerned about. So same scenario here. We can take in, say, $1 for this, and then our max risk is going to be $4, and that is where we will have that margin of $4. Now here's where the OCC comes in. They look at this. Okay, and let's put it together here. You have the bear put spread and the bull put spread and the bear call spread. All right, I haven't forgotten about the OCC. This is where they come into play. Okay, the OCC is smart. They know that a stock can't be in two places at one time. Okay, so while you get both credits, you get the credit for the put spread and you get the credit for the call spread, you only have one margin. Okay, one margin, and it's the width of your spreads. So in this case, my spreads are $5 wide. Okay, so I have $4 risk on both. Okay, but you don't add that together. You only have one margin, $4 in this case, because what I said, the OCC recognizes that the stock can't be in two places at one time. So they're not going to penalize you because you did it twice. Okay, you did the call side and you did the put side. No, it doesn't work that way. You get both credits because you sold two trades, but you just have one margin. So in this case, our max profit would be $2 and our max risk would be $4 in this case. And you can see here, it's ideally if the stock stays, between 48 and 52, but we still make a little bit of money down to the break evens of our trade. All right, that's how an iron condor works. We just want to stay within that trading range. Doesn't have to be right at one particular strike. It can bounce around a little bit. It can move around. That's all that we need to happen, is for it to stay in that range. And you know what? There's a lot of stocks that do this. A lot of stocks that do this through their earnings announcements. All right. So the setup here is you want to use expirations that are generally between 7 and 21 days. Okay. So we're trading pretty short term here. And the implied volatility is going to be medium to high. All right. You're never going to be able to hit the top of implied volatility. You don't really know when that occurs. Sometimes it occurs like 2 days before the earnings event and then ticks down. Sometimes it builds all through the earnings event. It's okay. You're not gonna worry about getting the absolute top of the earnings IV rush. It's just not even anything I ever think about. Okay, I just know that the pricing is going to be inflated a little bit, and that's what I'm after. So IV is already going to be medium to high there, and you want the stock to be quiet. You just want it to be historically quiet. And again, you're just concerned about the earnings day. There's some volatile stocks out there that where if you look over the course of say 3 weeks, the stock has moved $15 or so, but we're not worried about that. We're worried about what does it do through that day, because we know there's going to be IV crush after the earnings announcement, and then we only want a couple of days left before expiration, and most of the time we can let this thing expire worthless. We don't even need to take it off because the options are worthless. There's nothing to buy back, and it expires worthless, and we keep our entire credit. All right, that's what we're after. So the delta is close to zero. It doesn't have to be perfect. I already know the delta is going to be low, so I never really look at that honestly. But your delta is going to be pretty close to zero, which means the stock, you're going to make money from the stock staying where it is. The nice thing is that we have a theta decay on our side, which theta decay is time, and time is ticking away, and that actually helps us, and I'll show you that here in just a moment. So you want to make sure, now this last bullet point is pretty important, very important in fact. You want to make sure that your expiration of your trade is beyond the earnings announcement. It's on the back side of the earnings announcement, because if you put on a trade where your options expire before, you're going to get that IV rush, and the options could be more expensive when you try to exit. They might be pricier, which then you wouldn't make any money. You'd have a loss. Okay, so you want to wait till after the announcement, you get that IV crush, and then you look for your profit and whether or not you need to trade out of the trade. Okay, so let's go see how this would look on your broker site. Okay, so through most brokers have very similar platforms now where you can you have your puts on the right, your calls on the left, and you can usually click on the strikes, and here you would click on the bid, okay, or the asks on this, sorry, the ask price on this one, and then click on the bid, and you would sell a strike, a different strike. So in this case, we're buying the 56 calls, we're selling the 52 calls. All right, so you see your plus and your minus there. And then on the put side, you're going to buy, say the 44, it's at 12 cents, and then sell the 48s at 108. All right, and so there is your bull put spread, and that's what it would look like on your broker's platform when you highlight these things. And then those graphics go away, and you see these maybe red and green triangles or something to indicate you have a position open. All right, that's how those work. All right, and so that would create your iron condor, and all you have to do is click. All right, you can click to buy, click to sell, and it's amazingly easy these days. Okay, so some other things to consider: strike price placement is above and below the current strike price. Okay, so your put spread is going to be below current stock price, and your call spread is going to be above the current stock price. Okay, and the objective is that the stock is going to be between those short strikes at expiration. Okay, so you want to sell your put spread down below and sell your call spread up above, and just kind of bracket that thing and put the stock price in the middle. And putting it in the middle is your best, really gives you the best chance. Okay, the effects of time decay work in our favor. Okay, the theta decay is represented by dollars. Okay, that's time decay, and every day there's time decay on options. That's fighting the IV rush. Okay, so when we're in the trade, once we're in the trade and we get our price, now we're what's called theta positive, and time is on our side. Now, if you buy an option, for example, if you just went out and bought a call, you're theta negative in that case. time is eating away at the premium you have in that option until it goes in the money. As long as it's out of the money, you're subject to time decay, and that's not always a good thing, because sometimes the stock just doesn't move and you're like, what the heck's going on? All right. I like having time on my side. It just gives me an additional edge in the trade. Okay. So the effect of implied volatility is we sell high IV and wait for the IV crush to occur after the earnings announcement. Okay. That I just hammered that together. So let me give you some trade examples. Okay. These are real examples that we have given out to our subscribers. Okay. And these are very recent. All right, so let's look at some of these. This is through our Delta Neutral Income portfolio. As I mentioned, these are real trades provided to our traders, okay? And we're gonna first look at Home Depot here. All right, so on February 25th or 24th, we initiated a iron condor alert for Home Depot. Now you can see what you're looking at here is the risk graph on the right. Okay, you see the red, blue, green lines. Don't worry about those. Worry about the black line. The black line is at expiration. That's what that represents, at expiration. On the left is your stock chart. Okay, the light blue horizontal lines on the bottom and the top represent the break evens in the trade. So I want my trade to stay between those light blue lines. Okay, in between those light blue lines. That's how to read this chart. So the dark blue line, the horizontal dark blue line, is price. All right, so price shooting through there. So I have a range that looks to be about 404 on the top and about, I don't know, 358 maybe on the bottom is where the break evens are on this trade. So let's see what happens here. So we go out in time, all right, and we see a couple days later that the credit, we generated 66 cents on Home Depot. We did it 2 times. That was a $1.32 credit, okay, $132. Now, the thing is that we base everything on a hypothetical $10,000 account, all right? So a credit of $1.32, all right, at expiration, look what happens. It stayed between our break evens, okay? We had earnings, we had to wait about 3 days before expiration, and that is a 35% return on risk in 4 days, okay? In just 4 days, that's a 35% return on money, so $132 profit. Now, that doesn't seem like much. That is per spread that you do. So this is just one spread. And if you base that on a hypothetical $10,000 account, that is 1.32% return on portfolio in 4 days. 1.32% return on portfolio in just 4 days. Okay, 35% return on the risk that you took. Okay, we just let this thing expire worthless. There were no exit. The exit instructions were let this expire, and it did. All legs expired. We kept all $132, had a great trade. Okay, now next one is trade ID 1440. This was an iron condor on Ross Stores. Same situation. Look at that, stock's been bouncing around, moves a bunch. This is a $130 stock. Okay, we traded this right before the earnings announcement. This was a credit of 55 cents. We did it 2 times, so $1.10. This was done on March 4th of this year, so just a few weeks ago on Ross Stores. And we get into the earnings announcement, and boom, look at this. We have a perfect, we had a little volatility. Look at that big green candle right after the earnings announcement. It opened, gap down big, moved up, back up to where price was. This thing barely even moved net through earnings announcement. Okay, and so we netted a profit of $110. Okay, that's a 38% return on portfolio in just 3 days. Okay, or 38% return on risk in 3 days. That's a 1.1% return on portfolio. Okay, 1.1% return on portfolio in just 3 days. All right. And then the last one I have for you here is on Ollie, one of my favorite stocks to trade, Ollie's Bargain Outlets. All right. Just love the name, Ollie's Bargain Outlets. We did this on the 18th of March, just a couple of weeks ago. It's $1.30 credit. We did this one time. Okay, $1.30 credit because the risk, obviously here then is going to be, these were $5 wide. All right, we sold the 115s, bought the 120 on the calls. I sold the 90s, bought the 85s on the puts. That's $5 wide minus your credit, okay, of $1.30, and that would be $370 was my risk, $370 to make $1.30 here. All right, and then look at this, stock gapped up. Oh no, it gapped higher. Okay, but then not only did it stay in between our break evens, but then look, it traded down the next day and then barely up the next day after that. And we generated that $130. We allowed this to expire worthless, And again, that's a 1.3% return on portfolio. That was a $130 profit, which was a 36% return on risk in just 3 days. So here were 3 trades within about 3 weeks that generated almost 4% return on portfolio. We do this just one after another. All right, I'll give you a stock to watch for tomorrow morning. ConAgra, CAG, has earnings tomorrow morning. That's on my quiet stocks list, and it is don't expect much of a move out of it. Okay, so that's it for today, and I know I went through that pretty quickly, so I have a little gift for you. If you want to learn more and be able to take your time and read through it and look at examples, you can download the free ebook at ewotrader.com/condors. Okay, and we will be happy. That'll download right away. All right, and then if you have questions for us, all my contact info is in this little booklet, and you can reach out to us or go to ewotrader.com. You can see results and you can see historical averages, all that good stuff right there on our website. So that's my presentation.